If you want to know when the global system is about to crack, don't look at the stock market, look at the bond market. Stocks are the show, bonds are the wiring behind the walls. In 20 years in banking, I've learned that fixed income is the room for the adults. While stocks investors are busy chasing hype, headlines and memes, the bond desk is quietly reading the legal hierarchy of who actually gets paid when things go wrong. In that legal hierarchy, bondholders sit in the VIP section. In a corporate liquidation, there's a strict order of payment. First, the government for taxes, then the secured lenders, and then the bondholders. Shareholders? They stand at the very back of the line, waiting for the leftovers that usually never come. In this episode, I'm taking you inside the banker's vault. I'll show you how to use bonds in your portfolio. We're going to audit the mathematical floor, and I'll show you how roughly $17 billion of supposedly protected bonds were written down to zero during the Swiss banking crisis. How a tiny legal trigger and an emergency decision by a regulator changed the entire waterfall. The mathematical seatbelt known as Convexity, and why, here in 2026, lending money to the corporations might be one of the most mispriced risks in the market. Quick disclaimer, this is financial education, no investment advice. Let's strip away the jargon. A bond is not an investment in the way you think about a startup or tech stock. A bond is a legal contract. It is an IOU. When you buy a bond, you are the lender. You're giving your capital to the government or a company for a defined period of time. In exchange, they contractually agree to two things. First, paying you the coupon, your interest, and second, returning your original principal at the end, maturity. In my 2 decades in this industry, I've seen retail investors make the same fatal mistakes over and over again. They only look at the sticker yield, the nominal interest rate printed in the product. In banking, we only care about the real yield. This is your interest minus inflation. For years, real yields were negative. On paper, you were earning interest, but in reality, your purchasing power was slowly evaporating. Today, the tide has turned. As of January 2026, the US 10-year Treasury is yielding around 4%, 4.2. With inflation finally settling, you are earning a real positive return of about 2% just for holding a high-quality government contract. This 4.2% is now your hurdle rate. It's the unbribable judge. If another investment can't beat this risk-free baseline after costs and taxes, it has no economic right to be in your portfolio. Now we need to look under the hood. Most people think bonds are safe because the income is fixed. But the price of the bond moves every single second. The lever that moves it is duration. Think of duration like a seesaw. On one side, there's interest rates. On the other side, the market price of your bond. When market rates go up, the price of your bond must go down so that it stays attractive to new buyers. And when rates fall, the price of your existing bond needs to rise. Here's the rule of thumb we use in trading floor. For every 1% rise in interest rate, your bond's value drops by roughly its duration in percent. So, if you hold a bond with a 7-year duration and rates go up by 1%, you lose around 7% of your capital on paper. Instantly. But institutions have a secret weapon to manage this: positive convexity. Duration is a straight line. The real bond market is a curve. Convexity is your mathematical shock absorber with turbo boost. When interest rates fall, positive convexity makes your bond price rise faster than duration alone would suggest. And when rates rise, it acts like a brake, making the price fall a bit slower than the simple rule of thumb. In the volatile markets of 2026, professionals aren't just hunting for yield. We are hunting for bonds with solid positive convexity. They're not just income providers, they are structural stabilizers for the entire portfolio. So, we've established that as a bondholder, you typically have priority. You get paid before the shareholders. That is one of the basic pillars of modern finance, until March 2023. Credit Suisse, a titan of global banking, a 167-year-old institution and a symbol of Swiss stability, wealth, and money. As it spiraled toward forced rescue by UBS, the usual script didn't play out as investors expected. Under normal conditions, in a rescue or resolution, shareholders are the first to be wiped out. Creditors, especially bondholders, only take losses after the equity slice is gone. But this time, the Swiss regulator, FINMA, invoked an exceptional clause in the bond documentation and combined it with an emergency resolution powers. They declared what is known as a viability event and wrote down around $70 billion worth of additional Tier 1 bonds to zero. The shock? Shareholders, the ones who are supposed to be last in line, ended up receiving UBS shares, while AT1 bondholders were completely wiped out. The Swiss vault didn't explode from the outside, it was deliberately opened from the inside, under stress, using extraordinary tools that most retail investors never realized existed. This wasn't a classic market crash, it was a prospectus and resolution event. And it taught the banking world a brutal lesson. Your priority is only as strong as the exact legal wording and regulatory powers sitting on top of that contract. In institutional banking, the takeaway was clear. Most private investors should stay away from complex hybrid instruments like AT1s. If you want your bond exposure to act as a true floor, you focus on senior, secured and high-quality investment-grade debt, where the legal waterfall is still relatively clean and well tested. Now we get to where professionals actually make or lose serious money, the credit spread. Not all bonds are created equal. When you lend money to the US government, you get the so-called risk-free rate, today roughly 4.2–4.3% on longer maturities. When you lend to a corporation, you should demand a bonus for the risk that they might go bust. That bonus is called the credit spread. In January 2026, we see something dangerous. Investment-grade credit spreads, the extra yield for lending to high-quality companies, are near historical tight levels, around 75 basis points. That puts them in roughly the second percentile of the last 20 years. In plain English, you are taking corporate default risk, but the market is barely paying you for it. If recession hits and those spreads widen back to normal levels, corporate bond prices will fall, even if interest rates themselves do nothing. On the trading floor, we look at that as an asymmetric risk. The additional reward for lending to companies right now is tiny compared to the potential downside of economy stumbles. If you're building a floor for your portfolio, this is not the time to stretch for a little extra yield in corporate bonds. This is the time to let high-quality government bonds do the heavy lifting. So, how do you use all this in your own portfolio as a non-professional? In modern banking, we don't buy bonds just for income. We buy them as volatility dampeners and rebalancing ammunition. In a real crisis, equities, they trend to crash. And central banks often respond by cutting interest rates. When that happens, high-quality government bonds can surge in price. And that price spike is your dry powder. This allows you to rebalance. You sell some of the now expensive bonds to buy the blood in the streets equities that everyone else is dumping at a fire sale price. Here's a professional rulebook you can translate to your own situation. Age and horizon matter. If you're under 40 and have a long time horizon, your equity risk premium dominates. For many younger investors, heavy bond exposure in a taxable account is often unnecessary, especially if it crowds out long-term stock growth, the later career rule. If you're in your 50s or approaching retirement, bonds become a tool to control volatility and protect your withdrawal path. But don't forget taxes. Interest income is often taxed less favorable than long-term stock gains. Wherever you live, use tax-advantaged retirement structures, things like 401ks or IRAs in the US or similar retirement accounts in your country to hold your bond exposure more efficiently. The 80-20 framework. A simple starting point for many investors is keeping around 80% of your growth capital in equities and using about 20% in bonds as your mathematical floor. The exact number depends on your risk tolerance, but the idea is clear. Stocks are the engine and bonds are the stabilizer. Control your duration. Don't play hero with 30-year bonds if you don't need to. In a world of volatile inflation and policy shocks, sticking to short to intermediate duration, roughly 1 to 5 years, help you avoid the extreme price swings we've recently seen in long-term government debt. Audit the credit. This is not the moment to chase an extra 2% in yield by loading up on high-yield or junk bonds when spreads are this tight. Right now, a boring, high-quality government bond is much more reliable floor for a glamorous high-yield product that can drop like an equity in a downturn. Bonds can provide the floor under your portfolio, but only if you respect what they really are. Legal contracts with a specific place in capital structure. Mathematical interest rate exposure through duration, and real-world risks through credit spreads. If you ignore those, your floor can turn into a trapdoor. Used correctly, they are the stabilizer that keeps your ship upright when the storm hits. But if bonds are the stabilizer and stocks are the engine, who's actually steering the ship? In our next episode of this asset class series, we move into the aggressive world of actively managed funds. I'll show you why roughly 90% of fund managers are just closet indexes, charging you luxury fees for benchmark-like results, and the exact process we use to find the elite 10% who actually earn their keep. I'm Philip, stay skeptical, see you in the next video, and hit subscribe.